Couple of lessons from Ron Baron. He's the founder and CEO of Baron Capital, who manages more than $50 billion of client money in Indian equity markets. He has the record of outperforming the indices by a minimum of 5% since its founding and inception in 1982. Broadly, his approach is investing in good quality companies for the long term. Few of his beliefs and principles are big learnings for me. One of them is not trying to predict the market. According to him, even the federal government chairman or the federal bank chairman cannot predict the market. Now, he has famously described Alan Greenspan talking about irrational exuberance in 96, where he thought the market was too high. Now, after the statement of Alan Greenspan, from that point onwards, the market went up 80% in the next 3 years. So it's very clear that everyone does not know everything. He's another no compromising approach is to measure the business and the person running the business and give less weight to its stock prices. After buying a stock, he keeps on assessing the business performance and the management integrity, how they're running the business, and over the period of time, he gives comparatively lesser weightage to the price action of the stock in that particular period. Now, this is classical Warren Buffett approach. This approach to tackle the secondary markets is very similar of how you manage funds in private equity markets, which is to look at the profitability of the business and to look if the business is reinvesting the profits in its own business to make it larger. Now, the third and the most important thing, which again you talk about making his clients aware of the nature of growth of money in equity markets. He makes it very clear to his clients that the money will not grow consistently every day like interest or every month. It will not be a linear growth. There will be periods of outperforming returns as well as periods of underperforming returns, which will even out as more than average returns over a period of time. Now, for example, looking at own Baron Capital history, between 1999 and 2008, it was the toughest 9 years for the stock markets in US, where the market was down 30 to 40% on an average, and Baron funds made an average of only 3 to 4% return per annum for these 9 years. But post 2008, the average annual return was about 12 to 14%, and this covered up for the underperformance which was there before. The important aspect which I like about Baron is that it actually matches my own fundamental thinking, is that they don't own cryptocurrencies or gold. Physically, he treats cryptocurrency as a commodity, and as a principle, he does not invest in commodities. Another point worth noting is that according to Ron Baron, equity is the best possible hedge against inflation and depreciation of your own currency, whichever country you are. He says, and I quote, "The value of money will fall by half every 14 to 15 years, and everything I want to buy is going to double in price after every 14 or 15 years. So I regard stocks against depreciation of my currency. I want to own shares of businesses which can outpace inflation."